Hey everyone, welcome back to Corporate Dakota, the place where we pull back the curtains on corporate filings and see if the numbers tell the whole story or if they're just trying to pull a fast one. Today we're diving into Kennedy Wilson Holdings Incorporated's latest quarterly report. Get ready because this one has some interesting moves, especially when it comes to their real estate empire and how they're juggling debt and investments. So what are we looking at here? It is a snapshot of Kennedy Wilson's financial health for the 3 and 9 months ending the 30th of September 2025. Think of it as a checkup for the company, showing us their income, their bills, and what they own. And we're going to break down the most important numbers and what they actually mean for this real estate giant. Before we jump in, if you love getting plain English insights from these complex financial documents, do us a huge favor and subscribe. We also have a Discord community linked in the description below where we break down these filings even further and discuss them. First up, a quick look at their balance sheet as of the 30th of September 2025 compared to the end of last year. Their total assets have dipped slightly from around $7 billion to just under $6.7 billion. Now, that might sound like a lot, but when you see where some of that change comes from, it starts to make sense. They still own a massive amount of real estate worth over $4 billion. But that number also went down a bit, and their investments in other companies, which they call unconsolidated investments, also saw a slight reduction. On the flip side, their liabilities, what they owe to others, have also gone down. Mortgage debt is still their biggest bill, sitting at over $2.3 billion, but that is down from nearly $2.6 billion at the end of last year. Their unsecured debt also remains substantial, with over $1.8 billion owed. Now, let's talk about what belongs to the owners, the shareholders. Their additional paid-in capital, that is basically money shareholders have put in beyond the stock's face value. It is held steady at just over $1.7 billion. But their accumulated deficit, which is just the total of all their losses minus their gains over time, is growing. It is now over $600 million. This means that cumulatively, the company has lost more money than it has made. Their total equity has decreased from about $1.6 billion to just over $1.5 billion. Moving on to the income statement, which shows how much money they made and spent. For the 3 months ending the 30th of September 2025, total revenue was about $116 million, down from $127 million in the same period last year. Rental income, which is a big chunk of their business, saw a drop. But investment management fees, that is money they earn from managing other people's money, those went up. One of the brightest spots in their operations is their gains from selling real estate. For the 3 months ending the 30th of September 2025, they reported over $11 million in gains. And for the 9 months of the year so far, that number balloons to over $65 million. This indicates they're actively selling off assets. But of course they have expenses. Rental expenses, compensation, depreciation all contribute. For the 3 months ending the 30th of September 2025, their total expenses were around $108 million, and their interest expense, the cost of borrowing money, is substantial. Over $58 million for just that 3-month period. When you put it all together, for the 3 months ending the 30th of September 2025, they had a net loss attributable to common shareholders of over $21 million. That is actually a big improvement from a nearly $77 million loss in the same period last year, and for the 9 months of the year, the loss narrowed from over $109 million to about $68 million. This suggests they are moving in the right direction, cutting down on losses. Now, they also provide some non-GAAP numbers to give a different view. Adjusted EBITDA, which tries to show the core operating profitability by adding back certain expenses like depreciation and interest, was around $125 million for the 3-month period, a huge jump from $66 million last year, and for the 9 months it was $370 million, up from $348 million. This shows that despite the GAAP net losses, their underlying operations are improving. Let's talk about their real estate holdings. As of the 30th of September 2025, their real estate and acquired lease values are listed at over $4 billion, but that is after subtracting nearly $1 billion in accumulated depreciation and amortization. So the book value doesn't reflect the current market value. Their unconsolidated investments, where they own a piece of other projects but do not fully control them, are valued at nearly $1.7 billion at fair value. A significant portion of this, over $1.6 billion, is categorized as level 3 assets. That means their fair value is based on unobservable inputs, essentially management's estimates. This is where things can get a little subjective. Looking ahead, they have quite a bit of money they've committed to spend. As of the 30th of September 2025, they have about $212 million in unfulfilled capital commitments to their joint ventures and another $145 million for their loan portfolio. This means they will have to put more money into these projects in the future. And when you look at their upcoming bills, their total borrowings alone are over $4.6 billion. That includes significant mortgage debt and senior notes. While they've been managing to stay compliant with their debt covenants, a large amount of debt is a constant pressure. Now, here is an interesting point. While their total equity has decreased, their common shareholders' equity is listed at over $1.5 billion. This could be a sign that they are focusing on optimizing their capital structure, perhaps consolidating the company under the holdings entity. Let's talk about a big strategic move. They announced an agreement to acquire Toll Brothers apartment development platform for about $347 million. This is a significant expansion into multi-family development, and they expect to invest around $90 million of their own capital. This shows a clear strategy to grow their rental housing business. They are essentially buying a ready-made development machine. And then, just as we were wrapping up on the 4th of November 2025, the chairman and CEO William McMorrow, along with Fairfax Financial Holdings Limited, made a proposal to buy out all the outstanding common stock not owned by the consortium for $10.25 per share. This could mean a major change in ownership for Kennedy Wilson, potentially going private. The board is reviewing this proposal, but it is a huge development. Now, let's put on our Warren Buffett hat and analyze this. Kennedy Wilson is in the real estate game, and like any real estate company, they are facing headwinds from rising interest rates and economic uncertainty, but they are clearly active. The improved net income and the massive jump in adjusted EBITDA for the 3-month period are very encouraging signs. They are selling off non-core assets and seem to be focused on growth in the multifamily and rental housing sectors. The acquisition of Toll Brothers platform is a bold move that could significantly boost their investment management fees and development pipeline. However, the elephant in the room is their debt. Over $4.6 billion in contractual obligations is a lot. While they seem to be managing their covenants for now, any significant increase in interest rates or a downturn in the real estate market could put pressure on their ability to service this debt. The level 3 fair value investments, those based on estimates, add another layer of uncertainty. If those valuations drop, it could impact their reported equity. The recent takeover bid from the CEO in Fairfax is a major curveball. It signals that the leadership might see value in taking the company private, possibly to avoid public market pressures or to restructure more aggressively, or it could be a sign that they believe the stock is undervalued by the market. It is a complex situation. Looking at the financials, the improved operational results are a positive. The growth in investment management fees shows their asset management business is expanding, but the significant debt load and the reliance on estimates for a large portion of their investments are areas to watch closely. Overall, Kennedy Wilson is a company in transition. They are actively managing their portfolio, expanding their fee-based businesses, and making strategic acquisitions, all while navigating a challenging economic environment and now facing a potential buyout. It is a high-stakes game, and the next few quarters will be critical in seeing if their strategy pays off. Alright, that is our deep dive into Kennedy Wilson's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.